Hey guys, Rob Mitchell here. Thanks for joining me for Day Trading Margin Secrets. I want to share a couple things with you here about trading and how margin impacts the markets that you're trading in. And it's important when you're choosing a market to trade in that you understand some of these concepts. So I decided that I'd share them with you. Yeah. So let's take a look at what I got. I'll let you know a little bit more about trading rooms in a little bit. Yeah. So first off, past performance is not necessarily indicative of future results. There is a risk of loss trading futures. Yeah. Don't use the grocery money to trade. Yeah. So the methods I'm going to show you in this YouTube video, or the topics that we're going to discuss here, are intended to help you understand what primary factors move a market and how likely that is to be consistent for successfully day trading systems and strategies. Yeah, and how that can impact you. One of the most basic factors that influences price movement fundamentally is margin. Margins are set by the exchange. And if your broker offers you day trading margins, that's less than the exchange margin, then they've likely posted a bond, or they bought insurance, or they put up money to cover their book in case of loss, so that the exchange is indemnified. Yeah, so that the exchange isn't carrying the risk. This would ensure that the exchange will always get paid. Yeah, if there's a problem. One of the factors that can influence how low a broker will go on margin is how random the market for which they're offering a low day trading margin is. So they may actually choose more random markets to offer low margins on. That is a significant factor, and I'm going to describe here how that could be and how it actually feeds back on itself. Yeah. So, for example, if there's a lot of trading on both sides and the market doesn't go anywhere, yeah, you got traders going long and short all over the place, all in the same area, right? Then theoretically, they could offer infinite margin with no risk, because the market just doesn't go anywhere, because you got people going long, people going short all over the place, all in the same place. Yeah. So that might extend the question, well, why would a broker offer lower margins? Yeah. Brokers offer lower margins to increase trading activity. Yeah. If a trader has only a few $1,000s in their account but can trade 6 lots, then the broker will theoretically make more in commissions. And that's the reason they're in business. Yeah. Commissions is the reason they're in business. To a aspiring trader, that might look like an advantage. Yeah, it might look like an advantage. It may be a disadvantage, right? So those are things worth considering. So as a result, the brokerage, they might choose more random markets to offer low margins on, you know, summing that up. And this has the effect of attracting traders with small accounts who will likely trade aggressively with little money. Yeah. So, so it attracts traders who are less likely that they know what they're doing. Yeah. And it further tends to randomize the market even more, because at any given point, more and more traders are trading in both directions, theoretically, due to their not understanding what drives the market. Yeah. And so by lowering the margins, it actually even randomizes the market even more. And so because the broker can offer lower margins on more random markets with smaller risk, it actually becomes beneficial to them at some point to offer even lower margins. Yeah, even lower. So that will evolve, or it could evolve over time, lower and lower and lower and lower, which is an indication that it is beneficial for them to do so. Yeah, and that's based on the knowledge that the market's probably not going anywhere a larger percentage of the time than it would possibly in a market that doesn't have that going on. Yeah, and we'll take a look at a table in a second. Yeah, so as a result, I submit that the best margins may be on the worst markets to trade. They may be. Yeah. Worth thinking about. So all this that we've been discussing here is true, of course, until the market makes a huge, really fast move. That has a tendency to de-randomize the market. Market becomes directional and can result in quickly rising risk. Yeah, quickly rising risk. So all this said, you might ask the question, well, do I want to trade in a market that has more random activity, or do I want to trade in a market where the participants might actually know what they're doing? Yeah. Theoretically, if the participants know what they're doing, or they're more likely to know what they're doing, then by definition, that makes it more predictable, doesn't it? If the participants will drive a trend with less random activity, then it's easier to predict, and the market will play out repeating patterns more predictably, which is what we do as day traders. So none of this says that you can't trade successfully in a market with high random component. You can, but you may have to accept more risk for a given reward potential due to the randomization of price action over larger zones of price activity. So it becomes a function of how you trade also. So there's different considerations in there as well that you could ponder. So one might ask then, hey, if a market has a high random component, how might it behave compared to a market where the participants are more savvy? In the market that's less savvy, it'll likely range a lot, and when it breaks out, the moves may be more exaggerated. And this happens because the market goes from random towards non-random, because the pool of traders having to shift is larger. In other words, you get more people on both sides in the middle of a larger range, and so the breakouts may carry on in a bigger range as well. So a lot of consolidation, back and forth, chop, 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 and big scale, and then it breaks out and makes a big move. If you have a strategy for identifying a big move, that could be a really good thing. If you can stay out of the bigger chop that you would expect in the less savvy market. As a result, markets with pro traders are much more consistent, theoretically predictable than those that are not. There are other factors such as manipulation, the ratio of pros to amateurs, the percentage of hedgers versus speculators, and liquidity consideration. Because you might have a market that has really good margins on it, but there's no liquidity. You could also have a market that has really good margins on it that's just not particularly volatile, because it's traded by commercial traders in very large money amounts. The bond market may be a good example of that. So stuff's going to go in slow-mo there. There's going to be a lot of liquidity, and it may actually be very tight in those markets. On the next slide, I want to show you a table of the margin to value ratios of various popular markets. Now, this is an interesting thing, because I remember when I was a commodity trading advisor and I was trading thousands of accounts, I found out that brokers actually don't even know what I'm about to show you. It doesn't mean all brokers don't know that, but a lot of brokers don't really even know what I'm about to show you, which is super interesting. So personally, I look for markets to trade that do not attract massive numbers of amateur traders. It's just super simple. And I'm going to show you on this next slide how you do that, how you figure that out. So the resulting consistency and resultant predictability is huge. So this is a table here. I got the ES. These are just popular markets. This is today. I did all these numbers today, and I hope I didn't make a mistake on it. I went to the CME website and I got the multipliers off the contract specs to make sure I had those. That's this column here, multipliers. This is the initial margin from NinjaTrader as of today. You can search NinjaTrader margins or NinjaTrader commissions and pull up these things. Yeah. So these are the initial margins. So for the ES, the E-mini S&P, which is by far the most popular market, the initial margin is $12,980, but NinjaTrader is offering you a margin of $500 on that. The current price of the S&P, E-mini S&P, is $49.19, and if you multiply as a $50 a point, yeah, that's $245,950 worth of stock that you're going to trade for $500. It's a ratio of 491.9 to 1. Wow. Yeah. Yeah. So you can brag to all your friends that you traded 3 lot today. I traded $750,000 in stock today. Yeah. Well, that's cool if you're right. It can be disastrous if you're wrong with these kinds of ratios. So you need to be really careful. The most basic form of this is you multiply the price on your chart by the multiplier and the contract spec. And it gives you an idea of how much money you're actually controlling when you put on a trade. Yeah, $245,000. So the discount that they're giving here, the margin to the initial margin is about 26 to 1. You know, how about the NASDAQ? Well, the initial margin's 19,470. The margin's $1,000 on the NASDAQ at the on the NinjaTrader tables, and the price is currently about 17,587. Multiplier is 20. That's about $351,000 worth of stock, if I got that right. And that's a ratio of 351. It's not quite as hot. I'll say hot, not good, as the ES. And about a discount of 19.47. Yeah, 19.47, but divided by 1,000. How about the Russell? Yeah, that's about 199 to 1. Yeah, on the RTY. Be careful with the Russell. It's can be pretty thin. It can move really fast. You know, move really fast. Discount 14. Yeah, 14 on that one. How about gold? You know, gold's a initial margin 9,130. Yeah. Well, I think that's 100 on that. I might have made a mistake there. Yeah, you double check me. Don't rely on mine, but I think it's 100 on gold. Yeah, I might have still got the. Oh, I got the 100 here is correct. Yeah. So the margin's 1,000, 202. Yeah, and 913. And then crude oil is trading at $76. There's 1,000 barrels in the contract. $77. You know, initial margin. And that gives you a ratio of a 77. Yeah. So you'd be like, whoa, Rob, the ES is giving me like, 7, 8 times or something. 7 times, 6.5 times more juice. Yeah. Yeah. It's giving me that. Now there are volatility. You can also take into account volatility as well. Yeah. And if you wanted to in this computation as well. But I'm just showing that crude oil is $1,000 margin. It's twice as much as the ES, but it's not as pumped up. It's not nearly as pumped up. Yeah. So these kinds of considerations can be helpful for you deciding what market you're trading. But one thing that, as I said, I submit is that the more you go down this table, the more utterly consistent things will become. Yeah, not a guarantee, but this has been my observation over the years. Yeah. So I look for markets to trade that don't necessarily track massive numbers of amateur traders. The resulting consistency and resultant predictability is huge. Doesn't mean you can't trade as well in the ultra leveraged markets, but you'll need to be more skillful. That's my opinion. Yeah, that it's likely that you will need to be more skillful, particularly when the market is ranging, and how it ranges, the qualitative aspect of it. So this is a reason why I've always taught day trading in the crude oil, because if you can learn these concepts in crude oil where it's really consistent, it's the most consistent of any market I've seen. We've been doing this for the last 9 years in there. And so you learn the concepts more easily than you do in a market that's feeding you random data, because if the market's feeding you random data, it's a heck of a lot easier to learn in a market that is consistent. It's more difficult to learn in a market that has a huge random component to it. And that's just kind of common sense. So one of the ways that you know that it's that way in the stock indexes is you have massive variability in ranges. Some days the ranges are huge, some days the ranges are small, and you have to use what we call relative ranges in the stock indexes. Stock indexes are also manipulated by the Federal Reserve and effectively, and other factors. Like if the S&P 500 there's as many as 500 different companies that could influence the movement of that. So there's more inputs and less consistent. Crude oil is just one market that has one report a week, and more basic supply and demand factors drive that. And if you look at the size of the crude oil market, it's absolutely mind-boggling how big it actually is. So in the time I've been running the trading room, we've had massive jumps in our technology due to this consistency. Now we translate that over to the stock index room as well. But the technology that we've developed it on crude oil because it's utterly consistent. So we can see through the noise there when we do that. So I teach trading concepts in the oil room that can lead you to trade successfully with a focus on developing independence that goes well beyond just trading. So if you'd like to benefit from that, if you'd like to become independent so you can be successful on your own without dependency, consider coming over and joining us. But be sure to give it the time it deserves. You got some basic concepts in there, but it takes time to get good at something. It does. So you got to be sure you give it the time. If you like this video, please subscribe to the channel, like the video. We've had a substantial increase in the number of people following the channel. I'm very grateful for that. Thanks everybody for signing on with us. We've been growing. We're in a very niche, specialized market, and so particularly, so I'm grateful that people are finding us. So Stock Index Trading Room is moderated by Steve. Steve's a really great teacher. The oil trading room moderated by me. If you need help getting clear of limiting beliefs, other things that keep you from being able to be independent, go over to manifestingyourfuture.guru and sign on there and get the free stuff that we got there for you. So if you'd like to learn more about the indicators on which our technology is based, we've developed a whole trading technology over the years. Visit indicatorsmart.com. I'd like to thank you for joining me. There's a coupon code there if you'd like to come check us out. And I'd like to thank you again for joining me for this video and giving me the opportunity to share about what we really love doing. So thank you, and we'll see y'all in the next one.